Good afternoon and welcome to our live webinar, Strategic Budgeting for Condominium and Co-op Boards, hosted by PKF O'Connor Davies. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. We're pleased to offer live closed captioning throughout the webinar. To access the captions, please use the stream text link located in the chat section of your attendee panel. You will have the opportunity to submit text questions to today's presenters by clicking on the Q&A tab on the right-hand panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. This webinar is offering 1 CP credit in specialized knowledge. Polling questions will be launched in the Polls tab on your right-hand panel, and you will need to respond to 3 of the polling questions to receive credit. Polling questions will only appear as they launch. Please pay special attention as these polls will be launched periodically. CP certificates will be issued within 8 to 10 days via email. A copy of the PowerPoint slides and a recording of today's webinar will be made available to you via email 4 business days post-event. As we near the end of the webinar, we do have a very short survey which will be prompted, and your response is greatly appreciated. At this time, I would like to introduce Samuel Bada, partner with their real estate practice. Sam?
Thank you, Alana, and good afternoon, everyone. And to all the attendees who have joined us so far, we thank you very much for attending this webinar. As Alana mentioned, my name is Sam Bada, and I am an audit partner here with PKF O'Connor Davies. I am one of 3 audit partners here who services our co-op, condominium, and HOA clients. Our firm has been servicing co-ops and condos for a very long time, and we've developed many long-standing relationships during this time, and will continue to do so. I myself spend over half of my time on a daily basis providing services to co-ops and condominiums. Every once in a while, our firm likes to set up a webinar that caters specifically to our co-op and condo clients, and I think we have a very insightful presentation coming up, and we think you'll find it very useful and informative if you are involved in co-op and condo budget preparation and review. This presentation will cater to managing agents and board members of co-ops and condos, or even anyone who services co-ops and condos on a frequent basis. Again, we thank you very much for your attendance, and we hope you enjoy today's presentation. On that note, I am now going to pass it to one of our other partners here at our firm, Mr. Tom Sorrentino. Tom?
Thank you, Sam, and good afternoon, everyone. We are very happy that you could join us this afternoon on today's webinar. We're very pleased to have a very good presenter with us. His name is Michael Wolfe. He's the president of Wolfe Realty Services, and Michael provides consulting and advisory services to the real estate industry. And today his focus will be specifically, as Sam indicated, on cooperatives and condominiums in the budget process. Michael will share his knowledge and his insights and his experience with all the listeners today to give his insights and any tips on the budgeting process. As we know from doing audits of cooperatives and condominiums, a lot of the information that's in the financial statements gets measured against the budget on an annual basis. Today, Michael will give his insights on how the budget process works, some of the considerations that board members and management companies want to think about, and more importantly, for all of us to learn something new today. So without further ado, I will turn it over to Michael.
Good afternoon, everyone. Thank you for joining us. Very excited to be here today. And we're all grateful for PKF and their talented team for initiating and sponsoring this event. As I introduced, my name is Michael Wolfe, and I was the owner-operator of a management company for over 35 years. And my entire career has been really dedicated working with co-op and condo boards. What I'm doing currently, as was mentioned, I have a consulting firm, as well as I chair the Real Estate Board of New York's Residential Management Council, a member of the Council of New York Cooperatives and Condominiums Board. I teach at Union 32BJ. I'm a member of the PCCC, which is a Queens President's Council, and various other organizations relating to co-ops and condominiums. And I'm really pleased to welcome you to this webinar focused on a topic that's absolutely central to the financial health and long-term stability of every co-op and condo building in New York City. The annual operating budget, right? Embrace it. Don't be alarmed by it. Don't be afraid of it. Really do embrace it because it's so important to the people that you serve as well as you as board members. So whether you're a seasoned board member or newly elected, understanding how to build, manage, and communicate your building's budget is essential. And I key on the word communicate, right? We'll talk about how the budget's prepared, but communicating what the results of that budget is sometimes may not be received very well. So we'll touch on that. Not just for maintaining operations, but for fostering transparency and trust and fiscal responsibility, which is something that you have as a board member within your community. Over the next hour or so, we'll walk through the key components of a well-structured operating budget, discuss best practices for forecasting and cost control, and explore strategies for engaging shareholders and unit owners in the budgeting process. We'll also touch on common pitfalls and how to avoid them. So there's a lot about what goes into the budget, the great things about it, but also mistakes that could be made either by yourself or your management company with respect to communicating the results of that budget. So this session is designed to be practical, interactive, so please feel free to submit questions throughout, and we'll leave time at the end for Q&A. So once again, thank you. So here's our mission statement, right? The webinar is designed for board members, treasurers, and managers to understand budgets as both a financial safeguard and a planning tool. And if you're self-managed, obviously the board is putting this together. If you are professionally managed, clearly that's being done by your property management company. So I think that there's a lot to learn here today, and we're going to focus on different points, and your questions will be well received. Our agenda is robust. You see how many items we have here: operating versus capital budget. I won't read them all, self-explanatory. Steps in the process, labor, cash management, reserve fund planning. If you're fortunate enough to have a reserve, what do you do with it? Utility rates, and then of course Q&A. So operating versus capital. And I think this is an area where some boards just either don't understand it conceptually, forgive me, or the property management company. So to simplify it, it's really recurring income versus recurring expenses. So there are things that we'll drill down a little bit later on what shouldn't be included in an operating budget. I don't think it's necessarily subjective, but I've seen different budgets from buildings that we've taken over the course of my career that included things like transfer fees or interest income in an operating budget which shouldn't be there. And we'll talk a little bit about that further and why they shouldn't be there. The capital budget is that plan about long-term spending. And that long-term spending, some of which is immediate, but over a long term, because of compliance issues. Your FISP, which is your formerly Local Law 11, your building facade inspection reports, and Local Law 97, the Climate Mobilization Act. So compliance issues have certainly added a new wrinkle and a new burden on co-op and condo boards on how to afford that. So we certainly have that operating budget, which is that day-to-day and income versus expenses, but we can't lose sight of the capital budget because some of those capital budget items may also have debt service associated with them that's going to affect the operating budget. So the approval order. Now, this is what we believe in the industry, how it should work. Certainly, your management company works for you and you'll dictate what the process should be. But the management company should be preparing the budget for you. They're in the trenches. It shouldn't be your CPA. The management company knows or should know everything about your building, what's transpired, if they've been with you for quite some time, what the history has been. And if they've not been with you for quite some time, they should have the records of what the history should have been. And I think the best process would be that the management company prepares it. They then meet with your treasurer and they both get on the same page and say, we both agree. And then it's presented to the board. Now, certainly, if you want the management company to present it to the entire board out of the gate, that's your prerogative. But I always found that when the treasurer understands it fully and the management company understands it fully, it's a much easier transition to the board for approval. And that's the goal. You'll also see that I have a footnote on the bottom. Accountants or finance committee may be involved, and we'll talk about that a little bit further as well. So the timeline, what are the objectives? So certainly the goal should be a balanced budget. At least at a minimum, it should be balanced. And what are the objectives? What am I trying to do? When am I trying to do it by? Are there other things I'm trying to incorporate in that budget? Should I add more money to reserve? Should it just be a balanced budget? And then we also have to create that schedule. So most buildings are on a calendar year, meaning that any increase should be in effect for January 1st of each year. So you create that schedule. When should I begin? And you probably should begin over the summer and really dig deep into it and try to get a working draft sometime in September, early October. I know some are done later. Some boards don't want to deal with it immediately. They want to wait for the year end. But I think that the perfect timeline would be ready for a January 1 announcement, and any modification to maintenance or common charges should be taken into effect. We're also comparing previous budgets to actual results. What happened last year, the year before? Were we right about our assumptions? Did we have a huge deficit? Do we have a huge surplus? And why? So this is where I said I'd come back to possibly establishing a finance committee. Now, that finance committee could be the board, members of the board. It could be people with a certain expertise within your building. It could also be people that live in your building that are always barking about everything that you do, and you want to bring them into the process. So this way they're involved when there's less repercussions or less negative comments on a budget that includes an increase. So it really depends on your building. I think you'll know your building best with your property manager and decide what the best course of action should be. So this roadmap. So we talked about the calendar, and that should be in June, I would think, if not earlier, about what dates will be. And, what are those resident expectations? What's been done in the past? Those external dates will include, I want my budget approved by the board by October 31st. And plan those board meetings accordingly, unless you have a special budget meeting. And then certainly allowing for timely communication with the unit owners or shareholders. Now, if you end up with a approved budget, that has a fairly large increase that we know won't be received well. If you're in an annual meeting or you're in a room with your shareholders and unit owners and you said, who wants to pay more? I would think nobody's hand would go up. So sometimes the increase is so severe, and we're talking about double digits typically, that you would want to have a special meeting for it and explain why that is the case. Your managing agent could present that in concert with your accountant as well. And then also review budget assumptions. What's happening in the industry? What do insurance rates look like? Fuel, utilities. What am I assuming as the basis for the figures that I arrive at? Now, one thing you should do is, if you complete your budget timely, and that's done, let's say, with 9 months of data, so you do it in October as an example, before you announce to your shareholders and unit owners what that increase would be, it's probably prudent to review what's happened with the data or the income and expenses for the months trailing since you've prepared your budget, right? Is there any large swing, both positive and negative, that may result in a revision to the budget that it increases cost more or reduces them, right? Because now we have that snapshot, and I always like to use that 9 months of data that's through September, but things could happen over the course of a year, whether it be a city ordinance, right, or a change in your building, or some major repairs, or some borrowing that you did that you didn't anticipate, that may certainly have an effect on the operating budget, why you should review it again. So we're still on the strategy development and those first drafts and those assumptions. and the current knowledge of the property is so important. You know, an example would be that if you're in a pre-war building, and pre-war buildings typically have plumbing that's tired and plumbing leaks, which has an effect on repairs and maintenance, right? Because if you have a leak on a pipe, it may have caused water damage. You have to close the wall and do some other repairs. That you need to know what's transpired. What have I gone through the last few years? What do I anticipate? You know, anyone could take numbers and add 3% onto them and say, here's my budget, you know, Mr. and Mrs. Board Member. But the reality is, to do a budget in a proper way, we certainly need to focus on historical data and, you know, what we anticipate going forward. So property managers need to identify non-recurring expenses, and what they should be doing is reviewing the general ledger report. So expenses are made throughout the year. What if the coding is off, which is not unique to any management company? So what if a big plumbing expense was coded as real estate taxes? So the prudent process by the management company should be that they're reviewing a detailed ledger report for every category of income and expenses, and they're ensuring that the coding was done properly throughout the year. And then they're modifying and making changes so the numbers that they're looking at are accurate, you know, based on the categorization they're in. Also, the super plays a pivotal role in all of this. To not include the superintendent that's there day in and day out, that knows the building as well as the property manager, and in some cases better on the infrastructure side, just wouldn't be a prudent act. You know, engage as many people as possible that have great knowledge to incorporate into what you're trying to accomplish, right? The goal here is to get to the end of that year and review it and say, boy, I had a great budget, right? I was spot on. That variance, if any, is in single digits, not double digits. And we want that board to approve that budget and review it in great detail and understand it before they adopt it. Don't adopt it because somebody presented it to you, regardless of how much faith you have in them. Let them explain what the background was to arrive at what they're presenting to you. And it's certainly important as well to balance needs versus desires. So let's talk about an example of that. So if I had a building that had major issues in their PTAC units, or they had major issues in plumbing risers. And when I say issues, they need replacement, they're always breaking down, and spending a lot of money on repairs. To me, that's a need, not a desire. A desire would be, I'd really like to put a new floor down in the lobby, or I'd like to, you know, put new fixtures in the hallways. Those are desires, may not be needs. And some of the hallways I've seen over the course of my career are certainly extremely tired and exhausted and probably need that facelift. But we need to ensure that our infrastructure is sound and our operating budget, you know, is addressed in a proper fashion. So the goal here again is, upon approval, that those increases are implemented January 1. If they're not implemented January 1, now we're dealing with retroactive charges. So let's say, for example, a building had a 6% increase effective January 1. Couldn't decide on it. We're tentative about releasing that information to the residents. Now I make it effective March 1. Now I have to make up the 2 months. So I have a retroactive charge. Or maybe I increase the 6% to something higher, but then I'm artificially increasing something I don't need. So I think it's super important. I know it's the holidays. This usually occurs, but, you know, to get on that January 1 increase, you know, format and cadence is extremely important. You know, things not to overlook. So I want to avoid tunnel vision, where you're reviewing last year's income and expenses, and you're in this year's preparation, right, for next year. to lose sight of what occurred last year is a mistake. So if last year's budget resulted in a loss of $20,000 or $50,000 or $100,000, what am I going to do as a board to finance that shortfall? Am I going to increase maintenance more to make it up? Am I going to transfer money from reserve? Am I so cash rich that, which is also unlikely in most, boards, do I just leave it alone? Do I ignore it? Right? So we typically never have enough money. We could spend it all, whether it be on an operating basis or a capital basis. So there's got to be some thought process behind what do I do with last year's surplus or deficit. What I don't think you should do is use the surplus to offset next year's increase. All right? We have to look at the increase need in tunnel vision for that specific year, and then we can decide to do about the surplus or deficit. So if it's surplus, it can go into reserve. It can be used for other things. And if there's a deficit, we should talk about, what do we do about that deficit? So, accounts payable. Is your managing agent paying your bills on time? So the treasurer and the board should be looking at that accounts payable and make sure that was taken into account. Not all managing agents are created equally. Not all vendors bill as timely as they should. So is there a huge accounts payable that's lingering that we didn't take into account? And come January and February, we don't have enough money to pay the bills. Now, proper cash flow, huge issue for some buildings. What you should be doing is a cash flow projection. Can I meet the obligations of this budget on a monthly basis? It's not to say February, I'm not going to have enough money because I made January real estate tax payment, and I'm just not going to pay vendors for a month or two, or I'm going to do temporary transfer from reserve. The ideal scenario would be that I could meet my financial obligation on a monthly basis. And how do I do that? I have enough operating cash. Now, depending on your building, a co-op will need a little bit more because they have the real estate tax payments than a condo. But the cash flow projection will allow me to understand and plan to have proper cash flow. Don't suffocate your property manager from making timely payments because they don't have enough money. And what ends up happening is the chain reaction. The vendors are then upset. You get a reputation as a building for paying late, months late, not timely, right? Usually it's 30 days payable. So that cash flow is essential to proper operations. Do we have any major delinquencies? In a co-op, you have first lien. You'll see less of it. You have more power on the condo side, a little more problematic. And what we saw, certainly during the pandemic, was retail. No one anticipated that. Tenants were either leaving, not paying, and usually if you have enough retail in your building, those aspects, those commercial aspects, have a huge impact on your operating budget, right, on the income side. So, that's a certainly important thing to look at. And you have a lease coming due, right? So what we've seen is we had, whether it be banks or the CVSs of the world, and they were paying way above market and they were long-term leases, then all of a sudden they were coming due. So it's important to look at lease expirations while you're planning this. And then maintenance decisions. What am I doing about preventive maintenance? Is there an uptick in it? Is that included? And then vacancies in the building as a whole. Right? Residents, are we concerned we won't get common charges or maintenance? It doesn't happen often, just something to certainly think about. So I put up on the screen for you a sample co-op budget. You should have a lot more columns in here in the preparation, and the other columns would probably be audited figures for a couple of more years. So in this case, in kind of a abbreviated version of columns, we have the 25 budget, and then we have an actual estimate, right? Depending on the time that you prepare this. So if this was done in September, you're going to forecast 3 months. And then what the 26 budget looks like. Now, this is just a snapshot, right? We have our income and we have our expenditures. But as we turn the pages and we get a little deeper into it, you'll see the different categories here. Maintenance, late fees, move-in, move-outs. Now, I am not a big fan of including late fees, move-in, move-outs. Again, these are non-recurring. Can't necessarily anticipate what they are. And if you notice, in the 25 budget, they're all zeroed out. And then in the estimate actual, they included them just to let the board know what kind of, forecast they did. But things like transfer fees shouldn't be included. They're non-recurring. You don't have a crystal ball about the market. And really what boards did for a while is they included transfer fees in their operating budget because it was a great buffer, right? Think about that income that would keep maintenance or common charges down. And what happened was, and we saw this when we took over a few buildings like this, that when the market was stifled, there was zero transfer fees coming into the operating budget. Huge deficit at the end of the year, had to borrow from reserve, short-term assessment. I thought it was a mess. I think that transfer fees, interest income derived from reserve fund should stay there. Let those transfer fees build up reserve. They were really put in place to reduce the frequency and the amount of assessments. Doesn't mean you won't have any, but it certainly means that that income wasn't for that, right? And I'm repeating throughout this hour about recurring income versus recurring expenses, not things that happen occasionally or we can't necessarily target. Then we have a financial section. Obviously mortgage, if you have one, real estate taxes, corporate taxes, payroll expenses are in here as well. So that's obviously important. It's a really good breakdown to indicate that the property management firm has done their job, that they're really breaking it down in a granular fashion as to what goes into those group categories. Ultimately, you're probably going to share your budget for the next year with your residents, right? Probably in this format, maybe just the third column. If you want to get granular, you'll probably just give them the budget column, not necessarily last year's budget and the estimate. It really depends on your building and where you are, right? Sometimes with bad news, you want to give more information. And then there's other categories as well: operating expenses, water and sewer, gas, supplies. Now, each one of these has a general ledger associated with it that gives a breakdown of everything that's gone into it. And you may want to look at it. Now, interestingly enough, in this particular budget, apartment repairs and painting, $25,000 budget, they estimate 11.2 for the year, right? Significant reduction, and budgeting 15 for next year. So it went from 25 for 25 to 15 for 26. As I mentioned earlier, apartment repair and painting is a big category for most pre-wars because there's a direct correlation between plumbing repairs and system failures and the work that follows those items. So maybe this particular building had some good luck or some bad luck in prior years. Maybe they've done a lot of replacements and they don't anticipate the repairs to be as high going forward. So just by reading this and being in the industry long enough, that's how I could come to that conclusion in this particular building. Also, exterior repairs, you don't typically see a large amount in an operating budget because exterior repairs are typically with a FISP report that will be a capital expenditure. But this building may just have some leaks here and there. Could be roof leaks that we can get to without rigs and without scaffolding that may not apply to a FISP report. But again, every building may not have the same categories. You may not have windows. Windows may be the responsibility of the shareholder or the unit owner. You may have window cleaning. So again, just give me a sample of what the categorization looks like. And insurance, we're going to talk about in a moment. That category, along with mortgage and some of these compliance fees, are certainly driving these operating budgets in a much higher fashion than anything we've seen before. Let me just go back for a second. In this particular budget, if you notice, it's a break-even budget. And what I think is important is that boards should really think about, do they really want it just to break even? Now, if you're blessed with a reserve fund that people are envious of, maybe you don't want to add any money in for that slush fund. But it's prudent to continue to add funds into reserve fund because, as I mentioned earlier, there's never enough money. And condominiums, to be Fannie Mae compliant on the lending side, want to see a 10% reserve replenishment on an annual basis. Now, not all condominiums do it. Why don't they? Because they don't want to increase common charges by 10%. And the same thing on the co-op side, which seems to be following suit. If you have the 10% reserve replenishment in your operating budget, you could argue it's good practice because you're constantly feeding money into your rainy day fund. Also being Fannie Mae compliant for loans that require Fannie Mae backing. But lenders are in place to make loans, not to not make loans. So because you don't have it doesn't necessarily mean that your unit owners aren't be able to get loans. It just kind of shrinks the pool a bit. So it's really subjective what you do. But I see more and more buildings adding some form of reserve fund replenishment, as well as giving yourself a buffer in case you made a mistake in your budget. But to not approve a balanced budget is truly a mistake. And when I say approve a balanced budget, at a minimum, is truly a mistake, from a board perspective, right? We don't want to have a deficit and take money from reserve. We'll have to do short-term assessments, and we'll kind of speak about that a little bit more further. So it's a little snapshot. And look, one size doesn't fit all, giving you kind of a ballpark approach here, where on the co-op budgets and the condo budgets, look at the amount of fixed costs that are typically out of your control, leaving a very small percentage that you can control. So what does it mean? It means that you don't forget about the things you can't control, but you certainly spend a lot of time on the things you can. What could we do as a board and a management company, who's your first line of defense, to enhance those areas? How do I reduce costs and how do I increase income? Now, on the real estate taxes and mortgage interest, we're going to touch on a bit. I provided the tax rate here for 25 and 26. It's important to know that the real estate year in a building is mid-year, right? It's not January 1st of a building. So we have to take into account that we pretty much know the first half of what the real estate taxes are. And then we're guesstimating, right? We're guessing what the second half is. And, how do we do that? So we look at historical data. We speak to your certiorari attorney. What could that be? And they're certainly helpful with it. You should be filing an annual protest. And what that does is you hire an attorney that protests your assessment, and you only pay if they're successful in reducing it. Now, that's a wonderful relationship. And actually on this slide, the taxes billed should be July 1st through June 30th. We'll correct that on the slides that we send out, but it's July 1st through June 30th. So it's based on a fiscal year, not your calendar year. So that certiorari attorney, as they call them, will act on your behalf, and the city may come back and say, you're right, and we're going to reduce the assessment by X. That attorney will alert you. You'll make a decision whether you should accept it or not. You will typically accept if they recommend it. They will also perhaps share a recommendation not to accept it. In that case, they may combine several years, and they will actually start a legal proceeding against the city to reduce your rate. Over the last few years, they have not been as successful as they have in past, but we see things leveling off to a certain extent. And I just think it's absolutely prudent and necessary to file that petition. Same thing on the condo side, which we'll talk about in a moment. Now, real estate tax abatement credits for shareholders are typically shared by December. Now, these are people that are deemed eligible by the Department of Finance, not you, not your property manager. And unfortunately, there's still many shareholders that believe that you as a board or the managing agent is dictating or opining on whether somebody's eligible or not. Now, our role as management companies is to alert the resident that is named as ineligible. So this way, if they want to protest that, they certainly can. So real estate taxes continue to be a huge portion of your operating budgets. And when there is an increase, and it's usually phased in over 5 years, so really what you're dealing with is 1/5 of the last 5 years of what that increase is. So it's really important to hire a good attorney that'll act on your behalf. On the condo budget, as you probably know, the real estate taxes are paid directly by unit owners. They're not included in your operating budget, except if there's a superintendent's apartment. And the condominium should file a petition as well. But here's something to be cautious about. When you file this petition, you're successful, how do you pay the attorney's fee? So it's important that you check your governing documents, that you're entitled or you have the authority to file on behalf of everyone. And you may say to yourself, why wouldn't somebody want me to try to lower the taxes? The problem comes in when the bill comes in and you're assessing or recouping that bill, which most condos do. So that's something certainly to think about, and maybe speak to your attorney about that. Now, the bill could be thousands or could be tens of thousands, depending on how successful they were. Speak to your attorney about checking your governing documents. Do they have the authority to file on behalf of everyone? And if you don't, you should send out an authorization. But if you're a well-established condo, you've probably done that already. And credits for the real estate tax abatement will appear on individual bills of unit owners. And I can't emphasize enough how important it is that when your managing agent is aware of who has been deemed ineligible, that notices are provided to those people as soon as possible, because anyone that's deemed ineligible that feels they're not is never happy, right? It's a huge amount. On the labor side, if you're a union building, easy, right? Payroll rates are dictated by the collective bargaining agreement. Non-union payroll rates increase are probably based on what you want to do. But it's important that you stay within the prevailing wage that is set by the controller's office. If you do not pay prevailing wage in most buildings, right, you'll see there, but based on assessed value and unit size, that if you do not pay prevailing wage, you will not be eligible for the real estate tax abatement. Now, if you're a newer building on a different type of abatement, you may, stay away from the prevailing wage because it doesn't benefit you. But for most buildings, you're going to want to get that real estate tax abatement. You're going to want to pay prevailing wage. And there's also a side of it where, the labor pool will be better for you as well. So if you're not paying prevailing wage, the goal of those employees will probably be get into a situation where they can. And water rates. It's interesting when I was researching this a bit in anticipation of this presentation, and you'll see from 22 to 24, the average rate was, 4.03. Then for 25, city said, we're going to crank this one up, and it went to 8.5, and now they're anticipating, a lower increase. But depending on your building and your water usage, could be, significant. And I think that some buildings lose sight of, at least in some of the ones we've taken over from other entities, is that the commercial building or the commercial units, in most cases, should have a sub-meter. And that sub-meter should be read by an outside service, and you should bill them back accordingly. That should probably be in the lease you negotiated. But if that's missing or absent or not being read, you may be owed a lot of money. So this is something really important to look at. If you had a dry cleaner or a restaurant, car wash, just think how much water they're using, right? That's on your bill. Unless, of course, you have that sub-meter and you're billing back accordingly. So again, super important to take a look at, make sure that's happening within your income and should be part of your lease negotiation if it's not there now. Insurance rates. Got a call this morning from an attorney who said they're representing a few buildings whose umbrella rate went up sixfold. And I said, has it gone up a lot in the past? And they said, no. Well, I said, what's happening to you, this particular building, is what's happening to most buildings. There's this catch-up period, not only on the umbrella market, but also on building coverage. So the short story is there were probably 15 or so umbrella markets to go to. And most buildings had a $100 million umbrella or a $200 million umbrella. After the first couple of layers, the insurance companies were giving it away, right? There's no $100 million claims, at least not in our world for the most part. So, what's enough? And I'm not here to tell you what's enough, but what I can share with you is what's happened. That, your 100-unit building in New York City is now probably has a $10 million umbrella with a $100 million umbrella. Because due to market conditions in New York and labor law and outside, disasters, and the insurance market, the umbrella market in particular, kind of fell apart. So the 15 markets that we used to go to is now like 2 to 3. And they're much more strict. And they're removing aspects of it, like the D&O, the directors and officers, which should be extremely important to you, is not included anymore. It's usually excluded, which meant that your directors and officers had to get an increase in coverage and premium. But where I was going with all this is that initial hit on the umbrella probably happened once. If it's happened to you already, it's probably not happening again. So you probably reduced your coverage and you increased your premium by a significant amount. And on the building coverage size, the cost of rebuilding has gone up significantly. So what happened was a lot of insurance companies were not doing their part to review your building on an annual basis or every couple of years and figure out that, number one, is the number they're using for rebuilding and repairs on building coverage is way too low. And now they're playing catch up. So some buildings got a double whammy where the building coverage went through the roof, no pun intended, as well as the umbrella coverage. So there are carriers that are better than others with respect to the premiums, but there's a lot of rules that they want you to live by and rules that you probably should live by, which is ensuring that the people working in your building and for the people that work for the people that live in your building do not have an action over an exclusion, whereby the labor law comes in, where if somebody gets hurt that's hired by a vendor that you hire, there's no coverage. What happens? Goes to your coverage. Your building typically has a duty to defend, and they'll cover the claim in most cases, or at least the defense part. And what ends up resulting in your renewal is you may not get renewed, or the renewal premium is significantly higher. So you as a board will protect yourself through your managing agent by making sure that your broker or a third-party service is reviewing all insurance policies for the people that work in your building. And I'm not talking about the pizza delivery person or the bed. I mean, there's got to be some break in what's prudent and what's practical. But reviewing those policies, not the COI, right? So the certificate of insurance may list coverages, but you don't know what the exclusions are that are in the policies. They must review the policies. It may be a little bit of a painful process. for your property manager or the residents in your building, especially during alterations. But if you follow these rules and have this risk transfer, you're going to be in a much better place. Not necessarily the market, because there'll still be claims, but you as a building will be in a much better place. So the forecast, about 12.5%, which I put in this slide, that is a moving target. So the building that got hit with a huge increase last year, maybe that number is fine or it could be lower. But if you haven't seen an increase in your building coverage or umbrella in a while, you can be double digits easily, right? So get ahead of this. Find out what your broker's doing. Find out what your managing agent's doing, what coverage you have, what you should anticipate, and you may have to lower, the coverage and some of these deductibles to be able to afford this. But just don't leave yourself bare, right? Don't go with a $5 million umbrella. And when you're doing projects like FISP and other things, you certainly want it to have the right coverage. And I'll move off this slide in a moment, but even the painter that comes in with a ladder, that's a hazard, right? They could fall off the ladder. And instruct your building staff, do not lend out tools to residents or people. So if somebody comes down and said, I really need to borrow your power drill or your electric saw or your ladder, the answer should be no, because you'll be brought in that lawsuit. As not neighborly as that may sound. Reserve funds. So reserve funds should be rainy day, planning. Because you have a reserve fund doesn't mean that you won't need an assessment at any time. It just means you have money to offset frequency of assessments, amount of assessments, and maybe pay for some things that aren't such huge big ticket items. Those funds should be segregated. You should be conscious of the $250 limit on FDIC insurance. They should be in interest-bearing accounts. There should be 2 signers to move that money, probably a managing agent and a board member. The rule of thumb for many of the accounting firms was 3 months of maintenance or common charges. It really depends on your building. If you're a building that's pristine, that went through a lot of capital projects, it may be enough. But if you're a building that's really tired and have a lot of expenditures coming up, 3 months is nowhere near enough. Okay. Money management strategies, again, laddered CDs, T-bills. Don't go into Bitcoin. Don't go into things that are volatile. You're there to protect the money of the people that you represent. Laddering T-bills and CDs is always a good idea, maybe through a brokerage firm. Financing. 10-year T-bill, when I put the slides together, you see the rate there. And, the mortgage rates for smaller loans, about 150 basis points over that rate. And then for larger loans, about 110, 120 basis points over. But a lot of the loans that were 2.90 and that were 320 and 310, those are coming due in a couple of years. So we really have to be careful here. How are you going to plan for that? Are you going to pay it down? Are you going to have greater debt service? Should that be incorporated in my operating budget? It's that planning ahead and that foresight that's really going to make you more successful. Utility rates. Market not predictable. You may want to hire a third-party consultant if your property manager is not in that business of forecasting. You probably don't want to be in the Con Ed pool. You want to be probably with an ESCO. And you want to think about, what I've used, what do I forecast? I want to go to a long-term contract. And, the commodity is usually priced alone and the transportation separate. So if you have gas or electric, you could pay for the electric and the gas, and then the transportation is a separate factor. So you can mix and match this. You could lock in all of it. You could lock in the commodity. It could be for a year. It could be a floating rate, but you need to know what your options are to plan accordingly. By July 1st of 27, number 4 oil will not be permitted, so your permits won't be renewed. And that's something important to keep in mind if you have that type of fuel. And again, the fixed and floating rate, there's some really good consultants out there. As I mentioned, in the event that your property manager doesn't specialize in this, and they'll be able to provide you with historical data and explain to you why they recommend a certain path to prudency within your operating budget. So we're at 120, which is perfect timing, PKF team, right, to go into Q&A. Couldn't have timed it better. So please join me, Paul, onto the stage. Thank you all for listening. We will answer as many questions as we can in the time allotted. And thank you for allowing me to present to you today.
All right, thank you, Michael. Great job. We got a couple of questions that came in. So first one says, thank you for the very helpful presentation. How much time is typically required to prepare the first draft of an annual budget for an average size co-op condominium?
Well, it depends on your managing agent, what data they have. So I would think that if you're experienced, which you should be, and you have the data at your fingertips, once all the data is available to you, and what a management company should do, and I'm going to get to your answer, is they should have a list of things they need to prepare a budget. The general ledger report. So the finance team will provide that to the managing agent. 3 years of historical data, audited reports. In other words, you should get in there, ready to roll, and you should be able to put a budget together in probably 3 to 4 hours. If you're experienced, and sometimes even sooner, depending on the form of the data. Is it at your fingertips? Are you super experienced, which you should be if you're preparing a budget? And you should be able to do it that quickly, at least the first draft.
Okay. Thank you. Do you foresee additional increases in insurance over the next few years?
I do, as long as we continue to have a very weak umbrella market and we continue to have the amount of natural disasters, and as long as we continue to have labor law in New York, which seems to be standing out alone, can't imagine that they will not continue to go up. I do not anticipate, and again, no crystal ball because we don't know what will happen. If you got hit with that huge increase, you shouldn't see that type of increase again in the short term.
Okay, thank you. From your experience, do you see New York City buildings budgeting for expenditures for the required Local Law 97 costs? And if so, do you suggest any particular dollar amount or percentage that should be used as a guideline?
Well, you should have a forecast, and Local 97, the Climate Mobilization Act, you should have a forecast from your property manager of what your penalty will be based on the current state of your building. I'm always hopeful there'll be a change and there'll be grants or there'll be financing that is so attractive that it makes it a little bit more palatable for you. But at the end of the day, you're going to have a large expenditure if your penalty is very high. So at a minimum, you have to budget for the penalty that's forecasted for your building, but you should also be on a parallel path of budgeting, probably through borrowing or assessment or a line of credit or a combination thereof, meaning borrowing a mortgage, to finance the changes in your building to get that penalty as close to zero as possible, because we don't see much relief coming in the short term. So buildings that are ignoring it are making a huge mistake. And at a minimum, you should do a carbon study. And the carbon study will provide you with excellent data as to what you should be forecasting for those anticipated expenses.
Okay, thank you. 2 more questions just came in. By what percentage do you expect New York City tax rate to increase this November, December for real estate taxes?
I knew somebody was going to ask that, and I really didn't want to answer it. So with a change in mayor, right, a change in people running our city, put it that way, is we're not sure. So remember, there's 2 parts to this. There's the assessed value and there's the rate. And there are certain things that the mayor, whether it be the current mayor or the new mayor, could do without state approval. And the rate could be scary if that goes up by a lot. So I'm not avoiding the question. We just don't know. It's variable. But, I'd like to see budgets include probably 10 to 15% increase as a safeguard in that category. The other thing I would do is I would consult with your certiorari attorney, because what's super important is, have you been successful in reductions in the past? Because remember, you're going to get it 1/5 of that increase, not all of it in one time. So if the tax assessment goes up tremendously or the rate goes up tremendously, not all of it will be impacted at the same time.
Okay, thank you. And we'll end on this one. How many years forward does a condominium look when determining the reserve budget? 25 years, 30?
25 and 30, probably not. I think what is prudent is a 5 to 10 year forecast. Now, again, not all buildings are the same. You know, one thing about New York, we complain about all the compliance and all the extra costs we have, but we are super prudent in looking at our buildings, especially from the exterior aspect with FISP. So my suggestion is certainly do at a minimum a 5-year forecast of major components. Now, you could either do that through your managing agent, or you could hire a firm to do a reserve fund study. And we could probably do a half-hour on reserve fund studies, the pros and cons. One quick con is on a reserve fund study is they may look at plumbing that's been there 100 years and say you should replace it, and the cost is $5 million, but you're not replacing all your plumbing because, number one, you can't afford it. The cost of the restoration is more than the plumbing, and you're probably going to fix it through alterations and piecemeal, so which isn't necessarily not prudent. So I think you have to be careful with those. They could be issued in draft, but at a minimum, that 5-year snapshot and probably up to a 10-year snapshot. Some buildings try to go to 15 years out, and I'm not suggesting you shouldn't. It's just so many moving targets that 5 to 10 year will get you in a good place, but update it every 5 years. So if you have a 10-year forecast, that's probably good planning. And the reason, you know, on the co-op side, why 10 years, usually the financing is 10-year loans. But I think trying to look out 20, 25 years just probably will not add up for you.
All right, perfect. Well, thank you, Michael. That concludes today's webinar. I hope everybody found it useful and informative. And thanks again to Michael Wolfe of Wolfe Realty Services for presenting. If there's any remaining questions that you may have, please feel free to contact Michael. His information will be part of the slide deck that's available upon request. Or feel free to contact Tom Sorrentino, Samuel Bada, or myself, Paul Kruger at PKF O'Connor Davies. We'll try to get you the answer as soon as possible. Again, thank you all for attending, and please enjoy the rest of your day.
Nice day. Bye. Thank you.
Thanks, Paul. Thank you to our speakers, and thank you everyone for attending. If you haven't completed it already, we have launched our survey located in the survey tab of your panel. Just a reminder that a copy of the PowerPoint slides and a recording of today's webinar will be made available to attendees via email 4 business days post-event. Thank you again. Have a great rest of your day.